Okay, so welcome everyone. New week. Hopefully everybody has attempted their homework. It is due by the end of tonight at 11:59 p.m. So if you haven't taken a stab at it, please do so by the end of today. Whatever you've done up until this point will be automatically submitted, okay? And I will only take the best grade. So if you submitted something twice, I will not average. I will not take your worst grade. I'll only take your best grade. Okay, so don't worry about that. So today we're going to start now talking about the income statement in greater detail. So last class we talked about all of the things that are eventually going to go into the income statement, namely the revenues and the expense accounts that we subsequently close to income summary, and then that shows up on the income statement. And today we're going to talk about what the income statement is, what it looks like, how it's prepared, and why we're doing this. Okay, so remember, let's go back to the first concept. Why are we providing financial information in the first place? What are we trying to do? What are we trying to give people? Yeah. Okay, so we want external parties to invest in us. If we want external parties to invest in us, what do we need to tell them about ourselves? Okay, why do they care about those? What is that helping them do? Okay, so make decisions about whether or not this is a good investment. So we're trying to provide information that helps investors figure out specifically what the future cash flows are going to be, when they're going to expect to get them, and how likely it is that they're going to get them. Let me just back up and say, we are passing around a little sheet. Please put the serial number of your clicker in the little number space. Yeah. Okay. And if you don't have a clicker, there's a box here to get a clicker. If your clicker doesn't work, I have extra batteries, so on. Okay. So let's talk about the way in which the income statement actually accomplishes the goal of providing useful information to investors. So the first thing it does is it helps us evaluate the performance of management. What do I mean by it helps us evaluate the performance of management? Well, we've got a bunch of investors that are working, that are giving their money to a company, and the company is run by a manager who is separate from them. So I, as an investor, don't get an inside look as to what's going on in the company. I have to trust this manager to take my money and run it and do good things with it. So one of the things that the income statement is telling me is how well the manager is protecting my resources. So I can take a look back and say, did they do a good thing with the money I gave them? If not, I could kind of come up with one of two options. One is I could try and figure out a way to get rid of that management. And the other is I can try and figure out a way to get out of this company, right? So if the manager is entrenched and nobody else wants to get rid of him, I may choose to, sell off my shares because this is not a company that I want to, continue a relationship with. So that's the first thing the income statement can tell us. The second thing it can tell us is not only what happened in the past, but what's going to happen in the future. So I'm an investor and I'm trying to figure out, is this company going to do well in the future? Not, okay, so yeah, how well has it done so far? But also, where's it going? And what it's going to tell me is, if I look at income today, that's going to help me predict income in the future. Okay, if the company earned a lot of revenues this year, would it be reasonable to expect them to do similar or to achieve a similar performance next year? Similarly, not only can I forecast future income, but I'm going to forecast future cash flows. So if they made a lot of sales this year on credit, then hopefully next year I'll be collecting a lot of cash because the credit sales, the money will be coming in. So not only am I predicting future income, but I'm predicting future cash flows. And then I can also try and take a look at risks and uncertainty. So I look at maybe a couple of years worth of income. I see what's happening over time. Is this company steady and stable and increasing and growing at a nice rate, or is it kind of all over the place? If it's all over the place, that's not necessarily a bad thing. It just increases the amount of risk in my investment and therefore perhaps the amount of return that I would demand. Okay, so I'm trying to learn about this company, and earnings are going to help me do that. Okay, now, where does the income statement fail us? So I provide you information about revenues and expenses. Is that ideal? Are there any drawbacks of that kind of information that you could possibly come up with? You can always read the slide and then raise your hand based on that. So what do you think? I mean, is the income statement perfect? Have you ever heard about any companies, any scandals related to earnings, like companies misreporting? Okay, so we know that there are a whole bunch of different accounting choices companies can make, and depending on the choice they make, it may affect their earnings. And so it may be harder than we think to compare company A to company B if the rules that they're using to create that income statement are different. Okay, that's one problem. What else is a problem? So when we record income, let's say we make a bunch of sales on credit, and we record those sales. Are we definitely going to get that money? There's some chance we won't, right? Our customers may not pay us back. What happens? What do we do to deal with that problem or that possibility? We create an allowance for doubtful accounts and a bad debt expense. So the revenues are recorded, and then a bad debt expense is recorded to offset that. Okay, so we record the expense associated with credit sales. Is the bad debt expense always right? Why not? Okay, it's an estimate. We're predicting or forecasting what we think we won't collect. We could be wrong. So if you look at our earnings number and you say, this is solid, and next year things don't turn out like one of our major customers goes bankrupt, that earnings that we thought were really there aren't really there after all. Okay, so earnings requires estimates, and anything that requires estimates, of course, is going to have some potential for being inaccurate. It doesn't mean it's deliberately inaccurate. It just means, when you have a forecast, you have some error. Okay, so there's that. There are other things that we don't include on the financial statements that might be useful. Okay, so remember we had a couple of criteria. How does something get included on the income statement? It needs to be with a third party or arm's length transaction. It needs to be partially executed, and what else? We need to be able to measure it. So let's say we can't measure it. Even if we think it's important, it's not there. Let's say it hasn't been partially executed. Does that mean it's not important? Let's suppose we have an enormous contract with somebody, which is the biggest contract we've ever had in our company's history, and we're sure we're going to get the money a year from now. Wouldn't you as an investor like to know that? Because that's a forecast of something good that's going to happen. So there are things that we are forced by the rules to exclude that aren't necessarily things that we'd like to exclude from a purely investor information perspective. Okay, so those are some reasons why it's not useful. Now, that said, I'm going to tell you that earnings are the most forecasted number. So whenever you hear Wall Street analysts talk about something, they're going to talk about earnings per share. They're going to forecast companies' short-term earnings, like 1 year ahead earnings. Okay, it is by far the number that in press releases companies disclose and discuss the most. So when they have a conference call with either their analysts or potential investors, current investors, the thing they're talking about the most is their earnings. Okay, when companies don't have a successful year, so everyone expected their earnings to be $5 a share, and they only come in at $4.50. The stock price of that company generally drops significantly. On the other hand, if a company is expected to have $5 earnings per share and they actually earn $5.50, the stock price increases. So there's real effects of announcing your earnings. Okay, it's not like I'll tell you my earnings and nobody really cares about it. Obviously, it matters because when the investors take a look at what the outcome is, the stock price moves. Okay. Another thing is that managers genuinely care about stock price, in part because they have stock options, but they also care about earnings because they have bonuses that are based solely on accounting earnings. So if I tell you if you at least achieve $3 a share in earnings, you'll get another $1 million this year. Are you going to really try and get $3 a share this year? Absolutely. Okay. What if you think you're at $2.99? What are you going to try and do? You're going to try and find some way to eke out another penny of earnings, whether it's ethical or not. Okay, you shouldn't do that. I'm just saying you might. Okay, or one might. Okay. So if you're not so ethical, you might have incentives to increase your earnings through means that are not so appropriate, like maybe underestimate your bad debt or overestimate your revenues that you don't actually think you're going to be able to collect. Okay. On the other hand, let's say you're supposed to achieve $3 a share to get a bonus, and you're at like $2 a share. Well, you're probably there's no accounting tricks in the world that you could come up with to get you to the point where you're going to achieve the bonus. So you might go the other way. You might actually take a whole bunch of negative accruals, or what's called, like, they'll take a lot of expenses this year. What would the advantage of that be? Well, you're basically saving up for the future. So next year you can kind of pull that, if you take a lot of expenses this year, you overestimate your depreciation, then next year you can underestimate it, and maybe next year you'll get your bonus, since this year you weren't going to get it no matter what. Or some companies just like to prove that they're slow and steady. Okay, lots of companies think that if they show you smooth, steady income, that you're more likely to invest because you'll think it's a low-risk company, even if it's not. So let's say one year they have a lot of income, they might dampen it a little bit just to get so they look steady. If they have a low year, they can jack it up a little bit just so that they think people will value them more highly because their income stream is steady. Yep. Okay, so what is your responsibility, are you asking me, or what do you do? Okay, so, ethics-wise, your answer has to be no, okay? Reality, you want to keep your job, so what do? You look for opportunities that are within the scope of acceptable accounting practices. And as soon as you hit the line between what is acceptable and what is not, you have to say, no, this isn't acceptable anymore. Because ultimately, it's your neck that's on the line, right? If you're an internal auditor, it's a little bit different because, it's purely, then just as a CPA, you are expected to uphold the rules of GAAP. That is part of being a member of the AICPA. But if you're an external auditor, it is not only, it's your company's reputation that's on the line. If this company is found out subsequently to have been fraudulent, your whole company is going to get sued. Now, will they find you liable? I don't know. But it is, as a code of conduct, you absolutely must identify and detect any impropriety that you see going on. Okay, so there is a code of ethics, and when you take an auditing class, you'll learn exactly what the standards are of an external auditor. Okay. All right, so let me just give you a quote, which you'll see a million of these in the Wall Street Journal about kind of earnings issues, but basically, just to emphasize how important earnings are, Krispy Kreme had to restate their earnings for several years. They got in a lot of trouble. They were doing really well. Everyone was all hot on donuts. Do you remember, like, about 10 years ago, everyone was, like, all psyched about donuts again? And it was like we were lined at the Krispy Kreme. And all of a sudden, like 3 years later, Krispy Kreme was in the tank. Why? Because they were basically lying about their earnings. And why were they doing it? Well, Krispy Kreme's woes stemmed from, in part, this common 1990s practice, which was they would set earnings per share targets for analysts. So they would tell analysts, here's what we think we're going to get. The analysts would just repeat them, and then Wall Street would assume that they were going to achieve them, and then they would push to beat them by a penny. So they would say, we think we're going to have $3 a share. Then by the time the earnings announcement came out, they would say, oh, it was actually $3.01. We are so awesome. So they would kind of come up with an earnings forecast and then try and beat it. But what happens if you come up with an earnings forecast that you can't beat? You have to sort of artificially cook the books and create a penny that doesn't exist. So the panel noted also that executive bonuses were tied to exceeding growth targets. So if you're paid in order to have earnings that are growing, you're going to want to have earnings that are growing no matter what. Now, obviously, you could go the way that the Crazy Eddie guys went, which was steal less from the company. That's the worst case scenario. Or you can try and get real growth. But both of those things are, complicated. So another option would be trying to come up with accounting schemes to achieve growth. Not a good idea because they'll kind of end up coming back and haunting you, but in the short run, they sometimes seem appealing to management. Okay, how do we know that firms manipulate their earnings? Now, I'm going to tell you firms manipulate their earnings, but I'm also going to tell you like 98% of the firms are doing the right thing. Okay, they're not really playing around with their earnings too much. They're doing the right thing. But let's say this is a chart of firms' earnings. And this is all the firms in the economy. And you look at how they did last year and you compare it to how they did this year. So like 0 means last year we had $1, this year we had $1. 5 would mean last year we had $1, this year we have $1.05. Minus 5 would be last year we had $1, this year we have 95 cents. Okay, so everything looks kind of nice and smooth. Yeah, there are little jagged pieces here and there, but it's not a perfect distribution. What do you know? What is the one thing that's weird about this chart? Do you see anything weird? Well, it is a normal distribution, but what do you say? Okay, so there's one hole that's sort of bigger than normal. Like these holes are kind of small, but this hole is pretty big. And right next to it, there's this big line here. What is that all about? Well, here's what that's about. Okay? This is basically telling you, without showing you companies actually manipulate, it's saying, miraculously, when companies are slightly going to disappoint, like if they had $1 last year and they're just at 99 cents, they tend not almost no companies report that. Very few companies report a change from year to year of a penny. Okay, they don't want to look like they've done a penny worse. So all of the companies that should be reporting 99 cents but had $1 last year somehow managed to find another cent and end up in this giant pile up here. So there are way too many companies, relatively speaking, that are producing no change in earnings, and way too few that are producing minus 1 cent. And while we don't know for sure that those companies managed earnings, it's sufficiently pervasive that you kind of think, well, why would that happen? Why would it happen that exactly at minus 1 cent from one year to the next, there's so few firms reporting, and at exactly 1 cent, or at exactly 0, there's a huge number. So people have sort of said this is indirect evidence that companies manage earnings. So how can you do it, or why can you do it? We'll talk about all the rules that go into reporting income. But the message is, when you see companies, you as auditors, going insane and crazy about like, oh, we have to hit this earnings target, that's a bad mentality. Okay, it's a really bad environment and reporting condition when the only thing you're fixated on is this one earnings number, because that one earnings number is already an estimate. If everyone cares about it too much, then you've got to worry about the integrity of the process. Okay, so what are we going to have on our income statement? We're going to have revenues. You know about these, right? This is the stuff that increases our assets or reduces our liabilities. Typically, we call revenues those activities which are part of our normal core operation. Okay? We're going to contrast that with gains, which also increase our assets or decrease our liabilities. They're also increasing our income, But we call them gains usually when they're non-core or they're peripheral activities. So if we think about a company that's selling phones, all of the sales of phones would be part of their revenue stream. But if in a particular year they decide to move from one building to another building and they sell the land in the building, that would be, and if they achieve a gain, that would be a gain because normally they're not in the business of selling land and building, they're only in the business of selling telephones. Okay, so we're trying to identify what's the core business versus what's non-core. And by calling it revenues for core business and gains for non-core, we're able to differentiate which things are likely to recur from one year to the next and which aren't. Okay. Then we have expenses, which are outflows of assets. So in order to make money, you got to spend money. I'm sure you know that that's true. Okay, you have an outflow of assets, or you increase your liability. So let's suppose our employees work for us and we don't pay them. Do we have a salaries expense? Do we have a salaries expense? Yes, we do. Do we actually pay them cash? No, we don't. So we might have a salaries payable, an increase in a liability that's associated with an expense, or a decrease in an asset if we do pay them. So if our employees work for us and we do pay them, then we have a salaries expense and cash. Okay? What is the difference between an expense and a loss? Well, it's the same designation between a revenue and a gain. So expenses are normal, ongoing parts of the business, and losses, that term we tend to reserve for things which are more one-time in nature and not likely to recur from one year to the next. And they're certainly not part of our normal core business. So if we were to sell that land and building and actually experience a loss, we wouldn't want our investors to sort of punish us for that for years to come. They might recognize, oh, you've made a bad investment, you sold this at a loss, and there's some negative effect, but you're not going to have a similar loss year after year because once you've sold the building, it's sold, it's gone, it's not going to be sold again. Okay? So that's the difference between, say, revenues and gains or expenses and losses. Okay, what are some examples of revenues? How does a company generate revenues? Yeah. So you sell stuff. Sales revenue is okay. Service revenues. You sell a service. What else could you do? Okay, interest is so you lend money to someone else, and systematically they pay you interest. What else? Yeah. Rent. So you rent out a building, and they provide you rent revenue. I'm like, wow, where was I going with that? All right, what other kind of revenues can you? Let's suppose I'm like the Krispy Kreme company, and there are lots of little franchises, Krispy Kreme franchises. So it could be the case that the individual stores earn their own profits, but what do? They feed back some fees to me, the parent company. Okay, so I could have franchise fees or revenues that way. Okay, I could be the kind of company where, like a gym, where people pay me membership fees. Okay, a newspaper where people pay me subscription fees. Okay, all sorts. Yep. Okay, so yeah. Okay, so banks charge service fees both for handling your account and for specific things that could potentially go wrong within your account. Right? So if you deposit a check and somebody else bounces it, you pay a fee. Okay, so those are things which generate fees, which generate revenues. What about gains? How do companies end up getting gains? Right? Because it's not part of their normal ongoing business. Yeah. Okay, so selling property, plant, and equipment. So you can sell land, building, equipment. You normally have a machine. You're going to use it, right? Going concern says we're going to use it for the whole life of the machine. But at the end, we might dispose of it in some way. Okay? If we end up making some money on that, I'm not going to, look a gift horse in the mouth, but it's still not something I'm going to expect from year to year. Okay? If I've estimated correctly, there should be no gain because I would have incorporated that into my lower depreciation rate. So a gain could occur, but it's not something I'm going to expect from year to year. What else? Yeah. Okay, so like what kind of assets would increase that I could include as gains? Let's suppose I bought land last year for $100,000, and then this year I ask around and people say, oh, it's really worth $120,000. Would that $20,000 be the gain? Okay, so what kind of asset are you talking about? You're right. No, I mean, there are some. I'm just not that kind. Okay, so if you own shares in another company, so you own stocks or some other marketable securities, like so land and building, we recorded historical cost, remember, under the presumption that we're a going concern. But marketable securities are things that the company is buying and selling for the purpose of transacting and actually making short-term gains. Okay, so sometimes you'll have an investment portfolio. Any changes in the value of those could be recorded as a gain. Okay, not always, but often, depending on the size and the ownership. Yeah.
Is goodwill a gain? Like if you have a brand name,
okay, no. So I cannot remember. With the exception of some financial assets, I cannot increase the value of my company internally. The only way I can record a gain is if I sell it. Now, goodwill I can't sell because there's no such, it's not an asset. However, let's say I create a patent internally. Remember we talked about some assets you can include, some assets you can. So things like a patent which you're creating internally, I can't include that on my books. So on my books I have an asset worth 0. If I go and sell it to some other company that's going to use it, then I get to record a gain on the sale of this patent. So it doesn't have to be only property, plant, and equipment. There could be some other intangibles that I sell, okay, but I have to actually sell them. It can't just be that they end up having more value, right? So if I own something and I keep using it, even if its value has gone up, there's no gain. But they're buying, their historical cost is what they're paying for it, right? So from their perspective, they give you cash and they get a patent. Okay, so why would they need to do that is they basically they paid a lot of money, more than the assets were worth, okay? So why did they do that? Well, they must have thought that the benefits to them of owning the Kinkos would be greater in the future. But in the current period, the only measurable benefits were less than what they paid for it. So basically they had a clear loss because they were paying too much for the assets of the firm. Okay. All right. Now, other things that could happen, you could sue another company and actually win. That doesn't happen every day. And you don't really want to be the kind of firm that's your only source of revenue. Yeah, we sell a couple of phones on the side, but really what we do is we sue people who are passing by. That's not a good. But it happens every now and again. You'll get involved in some lawsuit and you will win. Okay, especially like a patent infringement lawsuit would be a common one. Yeah. Okay. And so those are, or you could actually buy. So let's say you have borrowed money. And then interest rates change, okay? You could potentially buy back your debt and have a gain. Okay, companies don't usually do that because the reason to buy back your debt is because interest rates have gone down. Okay, if interest rates have gone down, then the high interest rate debt has increased in value, and so you'd actually experience a loss. But it is possible, if you're desperate for a gain, that you might buy back some of your debt. So all of these things are like legitimate ways of, if you want to increase your income, you can buy back debt at a gain. Is that a good long-term strategy? No, it might be a really stupid idea because if you need the money, next year you're just going to go have to issue more debt and you potentially have to issue it at a higher rate. Okay, so it's not. Yes, it's legal, and yes, it's legitimate, but is it a good idea? So you're trying to evaluate the source of the revenues and the gains to see whether not only is the company making money, but how are they making money, and is it a good idea? Okay, so I've decided that we're going to use Apple as our kind of running example throughout the class, so when possible, I'll try and bring in their real financial statements for you to take a look at and see what they do. What does Apple do? What's their primary source of revenue, right, which we said was regular stuff. What do they do? Okay, so they innovate and design, but then like how do they just innovating and designing for the sake of innovation? Like we are making the world a better place, or we're actually then doing something with those innovations? What do they? How does Apple make money? Okay, what do they sell you? They sell laptops, desktops, iPods, phones. I mean, we know what they do, right? This is what they do. They sell desktops and laptops. And then they sell, so those are the Mac products, and then they sell iPods and other stuff. iTunes, that counts, okay? They sell iPhones and any revenues associated with their relationship with either Verizon or AT&T could be included in there, okay? All the other stuff, the iPad, like they sell those, like, not only do they sell the iPad, but they sell all the, like, accessories. That's the word, thank you very much. Other stuff, also known as other stuff, and then they sell software like iWork and iPhoto and I don't know, everything, any thing you can think of, they're selling. Okay, so here's where they're generating their revenue. So take a look at this company. You as accounting potential future accountants and accounting students, you should be able to read an income statement for any company and kind of get a pretty good sense of what this company does, even if you didn't know what they do. But of course, you know what Apple does, so it kind of helps you be even more sensible about this. So where are they making their money? A lot of money is coming from the iPhone. Where else are they making their money? iPads, okay, and laptops. So what would happen if you had some information like 95% of the population now owns a smartphone? Would that be, no, it's not true. I think it's like 15%. But let's say it was 95%. Would that cause you any concern? Yes? No? Maybe? Why? Why? So why are you concerned? What are you worried about? Okay, so they're making a ton of money on this. They're growing from one year to the next by like 87%. If everybody now has an iPhone, it's going to be pretty hard to continue that growth rate. Why are you not concerned? Is anyone not concerned? All right? They break all the time, okay? They come out with new ones, and people want to re-up every 30 years. So there is some cycle of, life cycle for a phone. It's not forever, right? So even if 95% of the people own one, that may be considered good news because that means they're more likely to buy another one in 2 years. Okay? It's just a matter of, but in terms of growth, we have to sort of think about whether this kind of growth rate is feasible in the future. You can see the growth. It's true, they have increased enormously, but the growth rate is actually decreasing. Right? They could obviously grow more from 09 to 10 because fewer people had smartphones. By now, the market's getting saturated and there's more competitors coming in. Okay, so you don't want to just forget granted. Okay, here's revenue. It's $108 billion done. We're finished. Right? You want to what's the source of this? Where's it coming from? Are we going to see more of this? And this is what your job is to provide. You're trying to not only tell people the total picture, but you're going to give them some better way of assessing what's going on. Okay, what does Apple, so if you look at, this is just all revenue, pure revenue stuff. Why? Because these are things that they do from year to year. They're recurring activities. However, they do have some gains and losses, which would be different from revenue. And they tell you, here's something that we have. We have marketable debt and equity securities carried at fair value, and we put the unrealized gains and losses on those on our income statement. Okay, so if we have some changes in the value of marketable securities, whether it's our debt or equity or other people's debt, it could be that we're lending people money. Okay, so it's marketable, it's an asset to us, even though it's called debt, or marketable securities, we would put unrealized gains or losses on the balance sheet. Okay. What are some typical expenses that companies have? Cost of goods sold. So in the case of Apple, that's all their product costs. What else? What are regular expenses?
Salary.
Labor, what was the second thing? Purchasing. Okay, so not the item itself, but the staff that is working behind the processing and procurement. So we have like sort of a general label for things, which we call sales, general, and administrative, which is sort of the lump of all the costs associated of making the sales and doing the business that are unrelated to the specific product. So the product, let's say the iPhone itself costs $100 to manufacture. It can't cost that much, maybe $20 to manufacture. And then all the other costs associated with both selling it and labor relations with other countries, we know which ones, and then other things like that would be lumped into sales, general, and administrative. Okay, what else could be in your ongoing expenses? Marketing, absolutely. Nobody markets more and better than Apple, right? They're constantly, and they spend a lot of money on that. Of course, it pays off, and then they have a huge premium over their actual prices, right? They can charge a lot of money for their goods because everyone wants one. Okay, what else? What other expenses do we have for companies? Rent. They have all these nice stores. Okay, they don't own those stores. They lease them. So they have a lot of rent expense. Do they lease them in good places or in like really kind of good places? So it's really high, right? They don't like open the next Mac store in like some, kind of like place where nobody's going to be able to buy a Mac, right? You kind of want to bring the stuff to the people that are going to spend the most money. So they just open one in like Grand Central Station, Penn Station, I don't know, one of the stations. Okay. What else? What other kind of expenses could companies have? Depreciation expense. So that's a cost of owning your assets. Okay. And sometimes depreciation expense might be lumped into somewhere else. It won't be a separate line item, but it's definitely there. Okay, what else? R&D. Okay, this is a company which spends a lot of money doing research, a lot of money on development. Freight, you mean to pay for their stuff? Yep. So usually that's included in the cost of goods sold. It's part of the product cost. You kind of just attach it, but that would certainly be a cost that they incur. How about, what if they have to borrow money? They have to pay interest. Okay, now Apple doesn't have to borrow any money. We know they have a lot, but most companies have that as a common expense. Okay, how about losses? Where do they come from? In some sense, all the things that created gains can also create losses. Let's say somebody sues you and you lose. Okay, that could be a loss. You don't want your investors to think every year we're going to lose a lawsuit, so you want to highlight that it's not an expense, it's a loss. But on the other hand, you could lose easily. Okay, it's possible that the value of your assets when you finally sell them has actually gone below the book value, in which case you would experience a loss, or you sell marketable securities at a loss. Why would you ever sell marketable securities at a loss? Well, sometimes you need the cash whether or not it's a great deal. Sometimes you might want to actually have a loss, because if you take the loss now, you get the cash now, and then next year you might be able to do something better with it and apply, and you'll end up not having to take the loss then. If you have some kind of, crazy weather situation and it causes damage to one of your facilities that's unnatural, like that you're not expecting, okay, it might be considered a loss. There's like a hailstorm and it breaks all the windows in your warehouse. Well, you're hoping that doesn't happen year after year. Now, if hailstorms are frequent, then maybe it wouldn't be considered a loss. It would be recurring. Okay, so if we're insured by someone else and we don't actually experience a loss, we don't record one. Okay, we would only record a loss if it's uninsured and we actually have to pay out of pocket for it. We also wouldn't record a loss necessarily if what happens is if we don't do anything about it. Okay, so let's suppose, this is not a great example, but let's say the hailstorm came and it broke some of the windows, but we can just put a tarp up and it's actually still functioning just as well as it was beforehand, as long as it's not really diminishing the functionality of the building. Do we really care since we weren't planning on selling it? Possibly not. Now, you should write down things when they've lost value, but if from the perspective of the firm, the functionality hasn't changed, you could potentially not experience a loss even in that case. But that would be kind of a question of judgment. Yeah. Yeah. Mm-hmm. It's not. You don't have to show anybody why you're now paying it, because you're not going to jack up the value of your land, even though they've jacked up the assessed value. But you are going to have a higher expense. So if you want to alert people to the fact that this is why our expense is higher, you would certainly inform them in some sort of narrative which says this year they reassessed and here's the impact. The reason, though, that would just be a regular expense is because once they assess it, you're going to have that higher tax bill from here on after. So it wouldn't legitimately be called sort of like a one-time loss. It would be an ongoing expense. It would just be a significant increase from the previous year, and you could just explain why. But you wouldn't do anything more than that. Yeah. Well, hopefully it is being covered, right? The loss of function, in the process, when you think about being covered, you should, a good insurance policy would cover also loss of use, right? And now, is it? I don't know, but that is an issue of writing a good insurance policy. However, because you've never recorded the value of the production, right? You've only recorded the cost of the production. You can't sort of have some opportunity or lost opportunity cost as an expense. Okay, you would just obviously perform much worse this year than you had in the past, and you would do your best to explain it. And you would say, this is not normal performance, here's why. That's the best you can do. Okay, so other things that could happen is if you did have an asset that you were using, and for some reason it was not as valuable as you thought, even though when something increases in value, you're not allowed to write it up, when something decreases in value, you should write it down. So let me give you an example. Suppose you have an asset, you think it's going to last you 5 years. After using it for 1 year, you realize it's only going to last a total of 2 years. You want to you want to come up with something that will recognize that asset has lost a lot of functionality. So you might take a loss immediately to recognize the fact that your asset isn't going to provide you 5 years of use. It's only going to provide you 2 years. Yeah. If you haven't taken depreciation yet, that might be okay. But on the other hand, you don't really necessarily want it to be a depreciation expense, because then people will assume that's your normal level of depreciation. Whereas this particular asset just happened to be a lemon, perhaps, and you want to recognize the fact that, well, normally we would be able to depreciate it over 5 years, but this one time we have this big impairment. Okay, so it's sort of, by designating it as a loss, you're actually identifying it as not normal. Okay. All right, so, yep. Okay, so if you lend money, like if you buy somebody else's bonds, or if you just make a sale on credit, if you make a sale on credit, you are required to have a bad debt expense, okay, which would be kind of considered to be an ongoing expense because it's part of making ongoing sales. However, if you actually have some significant credit risk that, one of your customers goes bankrupt and this was like your biggest customer and you didn't anticipate that, you might have a one-time loss. Of course, the effect is that, your future revenue is going to be significantly dampened as well, because you're not going to have this customer anymore. Okay, but you could, if you haven't adequately adjusted and you need to write off a particular account, you could call that a loss. Okay. All right, so there are two ways of presenting income statement information, and we tend to think that one is much more useful than the other. And if you look at real financial statements, you'll pretty much only see the multi-step. But nonetheless, the CPA exam likes to force you to learn about the single-step income statement, so we're going to just quickly go over that, although not spend too much time on it. So the single-step income statement just says, look, there are all these like inflows of assets, and there are all these outflows of assets. Let's pool together all the revenues and the gains and put them as like pluses, and all the expenses and losses, put those as minuses, and then the net is income. We don't really care about anything other than just putting together things that are either increasing income or decreasing income. Okay, so in this case, this is a company where they have two sources of revenue, sales and interest. Are those similar? Well, not really. Sales are part of your normal ongoing operations. Interest is just sort of a side if you happen to take some of your extra cash and invest it in something that generates interest, but it's not really your core business. Now, if, of course, you're a bank, then it would be, but normal companies, not. So if you receive the net, if they, okay, so they don't pay in 30 days. Okay, if you receive that sort of revenue, okay, I mean, I can't actually answer that without a sort of long and involved answer. Sometimes it would just get lumped into the price of the sale. Okay, so it would just be part of sale. So if you expect or anticipate that you're going to get that whole amount rather than say some slightly discounted amount, then you would just put that in sales up front. If you have some financing revenues as well, you can include that as a separate line item. Okay, if you generally expect that you won't be receiving the financing revenues, nonetheless, the way you want to, I mean, whether you think they're recurring or non-recurring, or the source of them, it is sort of different, right? In one case, you're actually making a sale, which is what your normal business is. In the other case, whether or not you get a little bit of interest revenue is a financing decision rather. Do you give people credit or not? Not, are you capable of making sales? And so I think while you would say that interest revenue is certainly recurring, it's not part of your core business, and you might think about those two things a little bit differently. Okay, but for the single-step income statement, it doesn't matter. It doesn't matter whether this happens all the time, it happens once, whether it's part of your core business, whether it's part of some peripheral business. So lots of companies have multiple, like you could think about a car company. They sell cars, but they also have a financing arm. Which is their core business? Well, you could argue they're both core. Right? This is two companies with the subsidiaries. Both of them make a lot of money. On the other hand, you could have a company that's primarily making sales and then just on the side happens to collect a little bit of revenues when their customers don't pay on time. Okay. Expenses, well, we're going to lump all of those together as well, both the ones that are related to the product, the ones that are related to the process, like the sales, the ones that are related to financing, and the ones that we can't avoid because the IRS is going to charge us a certain amount based on our performance this year. So a single-step income statement lumps all the revenues and gains in one pile and says total revenues or total inflows, all the expenses, and then the net is your net income. Earnings per share is just you take the income, you divide by the number of shares outstanding. Is that exactly precise? Well, no. There's some adjustments you might make to the number of shares outstanding, and it gets a little more complicated. But we're going to defer that till intermediate 2. Okay. So the pluses of the single-step income statement are what? It's super simple. All you do is you just look at your income summary account. You take all the stuff that you've just credited, okay, for the revenues, and you put that in one area. You take all the stuff that you've debited, you put that in another area, you got your income statement. Your income statement is effectively your income summary account. Okay, you don't have to make any fancy designations, no headers, nothing like that. Okay? So if we were going to take a super simple case, and we have to create this now ourselves, okay, it should take you 2 minutes. Create a single-step income statement from this company's information. All right, what's this company's net income? You're not ready? You want me to give you another minute? All right, I'll give you another minute. I made the numbers easy so you don't have to work too hard with your calculator. Just add it in your head. Oh. Makes it easier for everyone in case you've got a calculator. All right, what's income? Okay, so since we're not agreeing, let's. Okay, so what are the revenues? There's sales and okay, what were sales? 12500. So am I missing a zero? Was it 12,500? 250. No, it was 25, right? I have an extra zero here. Okay, and then 50. Okay. So, what is my total revenue? 1325. 1325000. Yes. Okay. How about my expenses? What are those? Well, we've got all this stuff here. Cost of goods sold, salaries, depreciation, interest, rent, income tax. Oops. Okay, we have cost of goods sold, depreciation, rent, interest, salaries, taxes. Okay. I would write them all separately, but that would require me to go back and look at what they all were. Okay, so what do we have? Okay. And what is earnings per share? Okay. So what do you like about this income statement, or what do you dislike about it? So if you go back to the data, okay, would you think that I should now be able to tell, like next year, should this company earn $2.25? Would that be a good forecast of what they're going to do next year? Should I just stop right there and say, look, I know income this year was $2.25, so why would anything be different? Let's just stick with it. Is that a good way of thinking about it? So you think it's just going to grow just because, hey, the world grows, things get bigger, there's inflation. Okay, that's fine. So let's say it's $2.30. Is that a good forecast? What is lacking in my forecasting? What am I ignoring about the information? I mean, I have a lot of information here, and I'm just looking at this number, 225. Should I be a little bit more critical about where the money's coming from? Like, what things would you expect maybe not to happen again or to happen again? Like, should I be able to generate sales next year? Hopefully, right? This is recurring, and this is part of my core business. How about interest revenue? Does that happen year to year, or does that happen only once? Year to year, right? The fact that we're calling it revenue sort of suggests that it's year to year, but is that part of my core business? No, right? So maybe I want to differentiate between core and non-core, but of course this is likely to recur. All right, how about the gain on sale of investments? I sold a bunch of investments. Do I have any once I sell the investments, do I have the investments anymore? So next year, am I going to be able to sell these investments and get another $50,000? No. I mean, maybe I have some other investments, but realistically, this gain is what? One time. The whole idea is it's not part of my normal operating business, so it's non-core and it's non-recurring. Okay, so maybe, if anything, I might want to reduce down my forecast of next year because I won't really expect that $50,000 to come about. So there's like, what, 50 cents that I would want to think about taking off of my income. All right, well, but maybe I can also take some expenses off. How about cost of goods sold? Isn't that pretty much tied to my sales? I can't not have, I mean, if I make more sales, I'm also going to have cost of goods sold. Okay, so that I can't avoid. That's recurring, and it's core. How about salaries? It's also, I mean, you don't make sales unless you have people working for you, whether they're working as sales staff or whether they're working as production staff. You can't actually make your sales without salaries. Okay, what about depreciation? Can I just stop depreciating my assets and just say, oh, they're just going to last as long as I want them to? No, right? It costs you money in order to have these assets. How does it cost you money? Well, you have to spend the money up front, and then in a couple of years, you're going to have to replace them. So I actually need to I'm consuming some of those assets. Okay, so that's core, unavoidable, recurring. How about interest? It's recurring because in all likelihood I've borrowed money and I have to pay interest on it. But I could, if I have enough cash this year, I could potentially pay down my debt. Okay, so it could be different. More importantly, it's not part of my normal business. My decision to borrow money or not borrow money has nothing to do with my sales productivity. Okay, so this, while it's probably recurring, it's non-core. Okay, so I might not consider this in the same way in terms of it's not something that I can maybe affect very much by different. So I can't do more marketing and change my interest expense, but I could potentially do more marketing and affect my sales. Okay, so the fact is this isn't really affected by my changes in the scale or size of my operating activities. How about rent? Can I avoid rent? Can I just stop paying that? Yes, I can stop paying that. Really? Yeah, okay, but then if I buy a building, that's going to cost. I'm going to have to depreciate it, right? So I can't avoid having some expenditure for facilities, right? It doesn't matter. I mean, let's say I'm not buying anything, I can't avoid the rent, right? I can't just stop renting my building because then I can't make sales. If I decide to go and buy a building, it's going to require a lot of cash up front, but then, of course, I own it. I don't have to pay rent expense, but I have to depreciate the building instead and have a higher depreciation expense. So this is part of my core business. How about income taxes? Well, unfortunately, they're recurring, but they're not really part of my business, right? It's whatever the government charges me. Wouldn't want to go down. Yes. Yes. Yes, absolutely. They are recurring in the sense that you have them every year, but they're a percentage. So it's recurring in that it belongs, the way I want to think about it is I can't avoid taxes. The question is, how much are my taxes? So now that I'm thinking about adjusting, I'm going to adjust $50,000 down for my income, but that was $50,000 of pure revenue. So what I can adjust back up a fraction. Let's say if I pay 40%, I can then take $20,000 back as sort of lowering my expenses. So I might not go all the way down and assume, I'm only going to make $1.75. I might say, I probably can make $1.95. Okay, so that would be how you adjust. It is recurring. It's just recurring based on the total amount of income. Now, of course, it also, some of these the tax rules and the accounting rules are different, and so whether or not you're taxed the same rate on your gains and on your normal expense, you'd have to sort of play around with that. But the fact is, we want to play around with it. Okay, we want to play around with this number, and we want to play around with this number. So how could we maybe do that better? And the answer would be, maybe we should start out with a better income statement. So let's try and start out with something that's more useful, and then we don't have to screw around with it quite so much. So how can we sort of do a better job? Well, we can have what's called a multi-step income statement. We can start with the core activities, which are the operating activities, okay, the stuff that's going on and recurring and so on. And then we can follow it up by things that are non-operating and distinguish between those that are recurring and those that are non-recurring. Okay, so what is the benefit of this more expansive income statement? Well, you kind of tie together the costs and the revenues that are associated. So the more sales we make, the higher the cost of goods sold. Okay, so yes, it's true that sales and cost of goods sold are recurring activities, but if I increase my sales, I'm going to increase my cost of goods sold. If I decrease my sales, I'm likely to decrease my cost of goods sold. Okay? Then I have some expenses which may not be nearly as flexible, like salaries. Yeah, it's true, the more I produce, the more labor I need, but if I cut back a little, I may not lay off nearly enough employees to perfectly compensate for the reduced production. Okay? So I have selling expenses, general marketing. I may still do a lot of marketing, but it's really unsuccessful. So I may have spent a lot of money on a marketing campaign, even though it didn't generate the sale. Okay, so those are less related or less kind of flex, or the prediction on those relative to sales, they may not be as consistent of a percentage of sales. And then it's basically providing me with sort of intermediate subtotals, and those subtotals are things that people sometimes forecast. Okay, so you'll hear people talk about gross margin. What is gross margin? Anyone know what we mean when we say the word gross margin? Yeah. What does that mean, though? What is it?
Whatever you sell minus whatever.
Okay, but what is that's sort of just profit. What is gross margin? Has a very specific definition. What do people mean when they say gross margin? They talk about your margins. It's even before that. Okay, so let's go to this. Gross margin is right here. Okay, so this is my income statement in a multi-step way. I start out and I first record sales, and then I record the cost of goods sold, because those are the direct costs associated with the sale. And I come up with a number called gross profit, which is just sales minus cost of goods sold. Okay. So that's gross profit. Gross margin just takes gross profit, sales minus cost of goods sold, or gross profit, and divides by sales. Gross margin tells you for every dollar of sales you make, here's how much it costs just to make the product, or just to have the product. So if it's inventory that you purchased from someone else, you would include all of the costs to get that inventory ready for sale. Okay, so you call up your supplier, they ship it over to you. It would include not only the individual invoice price, but it would also include the shipping costs. It would also include any taxes you have to pay on the product, and so on. Gross margin tells you for every dollar of sales I make, here's how much money I keep at the end. So, or inversely, if I keep 36 cents, that means it must have cost me 64 cents to make the product. Okay? So it's just the ratio of your gross profit to your sales. So how much you keep out of every dollar that you sell. Then I list my operating expenses. Now remember, these are the things that we're calling sort of part of the core, the things we can't avoid, but they're not things that are related directly to the product. So if I rent a building, I have to rent the building and pay the same amount no matter how much I sell. So it has a slightly different characteristic than, say, gross profit. Okay, so I have my selling expenses and my administrative expenses, and then I get to this line called income from operations. Okay, that's what sometimes operating income, yeah. No. Can we talk about, I'm happy to discuss this after class, but it's more involved. Okay, so we're now at income from operations. Income from operations sometimes is called operating income, sometimes income from operations, and sometimes we'll have some kooky acronyms for these things. Okay, so after we take income from operations, we have these other revenues like interest expense and interest revenue. So what is this number? Well, this is earnings before we took interest. Okay, so, and it's earnings before our tax expense. So in this case, this is also sometimes called earnings before interest and taxes, or EBIT. Okay, it's not a very elegant sounding title, but if you want to know what this stands for, it stands for earnings before interest and taxes. Now, in this particular case, there's no other, gains and other than, there's no other revenues and expenses, gains and losses other than interest and taxes. So income from operations is the same as EBIT. It could be the case, though, that there are some other gains and revenues that would show up in that number if they existed. It's just in this. So it's not always that income from operations is exactly EBIT. In this case, it just happens to be that. Yeah. Well, in this case, okay, our depreciation expense might be included as part of cost of goods sold. We don't know what our depreciation expense specifically was. So if I want EBITDA, I have to pull out of cost of goods sold the portion associated with depreciation. So there's another, also not very elegant acronym called EBITDA, which is earnings before interest, taxes, and then this part is depreciation and amortization. So let's just say you're on a job interview, which is going to happen, and some person is trying to like scare you off by throwing out all these like stupid names like EBITDA, blah, blah, EBITDA, cost of goods sold, this and that and the other thing. Don't be scared off, okay? For the most part, you probably know what it is. You just may not have heard that expression before. And just now you know. You know what EBITDA is. It just means earnings before interest, taxes, depreciation, and amortization. What is this telling you that, say, just net income isn't telling you? Well, it's trying to pull out the financing portion, which is the interest stuff. Okay? It's trying to look at things before taxes. Why? Well, from a debt perspective, okay, we want to know, can we pay our creditors? Well, luckily, paying your creditors is something that actually reduces your taxes. So we want to know, can we pay our creditors before we've paid our taxes, not after our taxes? So that's why we think about it before taxes. Okay, because I want to know, do I have enough money to pay my creditors? Depreciation and amortization, well, that's a non-cash expense. Yes, we have to pay money for our investments, and no, we can't avoid it, but we don't have to pay in cash on an annual basis. So if we're just kind of interested in cash flows, EBITDA is getting us sort of in the direction of a measure of cash flows and a measure of how well we can cover our ability to pay debt. So if, somebody asks you some question about items on the income statement, you can now answer them intelligently. You can say, oh, well, the reason, you're adding back depreciation and amortization is because it's a non-cash expense. And we want to know whether we have enough cash to, service our debt. That's all they're asking. But a lot of people will use these terms to kind of differentiate, like where they use lingo to scare you off. Don't be scared. Okay, it's all trivia. Yeah. Right. So they have, usually, these actually would even be combined into something called SG&A, which is selling, general, and administrative. Okay, and we just put those all into one line item. The reason we put them all into one line item is otherwise we start to get a really long income statement. This company is really simple, but if the company gets more and more complicated, there are more and more lines, so we just lump them together. And the idea is generally they kind of go sort of they are obviously a function of sales in that the more sales you make, the more support you need to make those sales. However, they're sticky in that you can't always just scale them up and scale them down trivially. So even if you're having a good year, it's not always so easy to hire new, let's say you want to do more research and development. Well, it's not so easy to just go and hire a bunch more scientists. You have to actually get some decent people. So they're sort of related to the size of sales, but they're not as easily scaled up and down as, say, cost of goods sold. And the reason they're lumped together is they kind of have similar characteristics. Okay? All right. So then we've got other stuff. Now we're standing here. Sometimes you'll see income before taxes. That would just be another way to EBT, earnings before taxes. Income and earnings are the same thing. Okay? And then finally, you have your tax expense and net income. Okay? So all these things that you might see people talk about, this is all there is. Do we have a number that's different than the one we had on our multi-step income statement? No, we do not. Whoops. Okay, it's exactly the same. It's not like I'm telling you new information. Okay, I told you $55,000 is income on the single step, and I'm telling you $55,000 is income on the multi-step. So have I told you anything different? Is this more useful? It's more detailed. All the items are the same, though. So is it more detailed? What's it doing for you? It's Okay, so what it's doing is it's grouping things in a way that makes it more helpful for me to make a forecast in the future. So when I look at sales, that's the number I'm going to forecast first. And then cost of goods sold is going to be, obviously, the more sales I make, the higher the cost of goods sold. The fewer sales I make, the lower. That thing is kind of, those things generally go in sync together. Now, could I work really hard to reduce the cost of my product? Sure. Okay, but generally speaking, unless there's some active effort to do so, those things are going to go together. On the other hand, selling and administrative may be more stable and unrelated to, fluctuations in sales for a given year. Or they may scale up, but they may not scale up at the same rate, okay, or down. Then interest revenue and interest expense. This depends on the financing decisions I make, not on the sales decisions I make. Now, obviously, if the only source of interest revenue is my sales, then of course interest revenue might be driven by sales, but interest expense is not really related to sales, it's related to borrowing. So those are things that are different. And then taxes, well, that's just, how can I calculate my taxes until I figure out what all my other expenses are? So taxes is directly a function of income before taxes. So basically this is creating my income statement in a way which helps me predict better what my future income will be, and I can highlight the things that I want to include and the things that I don't want to include. Okay, so that's what you're getting out of a multi-step income statement. And so hereafter, it's not that I want to suggest that the single-step income statement doesn't have any value, but for the most part, you're going to see, whenever you look at a real company's financial statement, you're going to see multi-step income statements.